I discovered Bitcoin in like 2013 or 14, basically buying fake IDs on the Silk Road at the same time as Venezuela was going through the worst hyperinflation that the world has seen. We're going all in on it. We're putting all our money into it. We're staking our careers. The toughest thing has been the moment of deep uncertainty. We raised our first fund in 2022, and we had a bunch of money going into the FTX or going into the Luna crash. Just want to back the best founders that are building the biggest bot networks that are disrupting real world use cases.
This season of the Inquisitive VC is proudly sponsored by Carta. Carta is transforming how private capital operates, connecting founders, investors, and LPs through purpose-built software and services. Trusted by over 65,000 companies in over 160 countries, Carta supports everything from equity management to fund administration, powering nearly $185 billion in assets across over 9,000 funds and SPVs. Whether you're building a company or managing a fund, Carta is the modern infrastructure private markets have been waiting for. If you'd like to find out more, check out their website in the show notes. Welcome to the first episode of Season 1 of the Inquisitive VC, where we explore the journeys of innovative entrepreneurs and investors in the world of venture capital and crypto. Today, I'm excited to have with us Sal Gala, founding partner of EV3, a venture fund focused on real-world crypto use cases and DePin investments. Sal's journey is a fascinating one, from his early days experimenting with Bitcoin to co-founding a venture fund that's making waves in the crypto investment landscape. In this episode, we will dive into Sal's unique perspective on the future of blockchain, his experiences in raising capital, and the philosophy behind escape velocity. So I wanted to, start with maybe just to level set a little bit of background on yourself in terms of your first role at a VC firm, and then we'll look into the next steps from there.
Absolutely. So just for context, my name is Sal. I run a venture fund called EV3, and I'm one of the founding partners along with my co-founder Mahesh. I'm originally from Venezuela, but grew up in the States. And there was this point in time, I think I discovered got into Bitcoin in like 2013 or 14, basically buying fake IDs on the Silk Road. And in 2014, 15, 16, there was a point in time where Bitcoin had these incredible years of price performance at the same time as Venezuela was going through like some of the worst hyperinflation that the world has seen over the past few decades. Like they literally were cutting off, they cut off 5 zeros off the currency one year and 6 zeros the next year. So it was a 10 to the 13th power devaluation. And so I was 16 or 17 at the time, a very impressionable age, and just got fully around the idea of sovereign individuals and basically taking control away from nation states. And so for me, it was always very philosophical. Anyways, we ended up working in finance after school, went and worked for an investment firm called Ribbit Capital after doing 2 years of banking. And Ribbit is this incredible firm where I had an awesome training experience, and that they're a global stage agnostic fintech and crypto investors. They were buying Bitcoin in their 2012 and 2013 funds. They did stuff like the Coinbase and Robinhood Series A, and had continued basically being at the center of the fintech ecosystem since the very beginning, and doubling and tripling, quadrupling down on it in a way that very few other people have. And yeah, after investing at Ribbit for a handful of years, Mahesh and I were both stayed very close friends. We used to work together at Goldman and were investing in things on the side. And we were both hyper captivated by this new category of businesses in crypto that very, very few people were paying attention to, which were trying to create some tangible real world value, which was decoupled from not serving explicitly blockchain use cases, not serving trading, not layer ones, not blockchain gaming, but serving some real utility in the world that you could charge fiat currency for, and try to tie those economics back into a network where the function of the network is to solve some real world coordination problem and allow the creation of user generated services on top of a global community of people in a permissionless way. The first instantiation of the clear evidence of this, and we were in the right place at the right time, was Filecoin and Helium in late 2020 to early 2022. There was a 2-year period where Filecoin went from zeros, 15 exabytes of data of storage capacity. Helium went from 10,000 to a million hotspots over 18 months. And so we got, just being lucky, frankly, had a front row seat to these ecosystems and saw that, holy shit, the incentive power to scale networks faster than has ever ever been done before is clearly here. And the question of whether you can monetize the capacity, the economics of it, sort of the regulations, there was a lot of risk for sure at that point in time. but there was also lightning in a bottle. And for us, it felt like nobody else in crypto was paying attention to it. It was very hard to get it through IC at, people didn't understand. Our friends weren't excited about it. There just weren't any mental models for these types of businesses in crypto because the cohort of people who had made money in crypto and started funds and everything had done it investing in these other categories that were very crypto native. And so we thought there was a point in time opportunity whereby the design space of what real world crypto use cases were starting to emerge was going to expand massively. And we felt that we could build an edge. Investors were not giving it enough credit to the point where if we really went all in on the ecosystem, we can build a sustainable edge and invest there. And so that's what we've been up to for the past few years, investing in DePin and other real world use cases like zkTLS and building out different events, conferences, podcasts, media analytics tools, and other public goods for the community to help it accelerate faster.
Love it. And I guess to kind of get into a little bit of the weeds, why did you choose the name Escape Velocity? And what's the more detailed thesis around that thinking of it?
Yeah, I got to give Mahesh credit for this because thank God we didn't, but I wanted to name EV3. I'm a huge Atlas Shrugged. Again, I read Atlas Shrugged at the same time that I was getting into Bitcoin, and Venezuela was having this hyperinflationary period. So I got very killed by it. And I wanted to name it the 22nd Century Token Company or something dumb like that. And Mahesh made the choice to call it EV3. Basically, because that's what we see us providing to founders. It's we think that the job of a pre-seed investor is really to get these networks to escape velocity. One of the things we've learned from our investing careers, I think the venture ecosystem has been multi-stage firms that promise multiple layers of capital to founders in advance after the first round. I think this is one of the biggest mistakes that venture firms have done in the history of it. I think it's a terrible offering for both founders and venture firms on a long time frame. It's sort of a promise you can't really keep if you're a fiduciary to LPs. And I think it sends all sorts of negative signaling. So we view our job as from day zero when we're investing to the point where these networks have escape velocity and big ecosystems and communities around them. Our job is to accelerate that as quickly as possible. And that's the origin of the name Escape Velocity.
Gotcha. I think you made an interesting point. I feel like you probably understand what you said quite deeply, being a venture investor and starting a fund, in terms of the difference of a multi-level firm investing across stages. How do you think founders think about that? Because I feel like not all of them really understand venture as deeply in terms of how it works. So do you find that it's still it's competitive, or some sort of education required for founders to understand you don't necessarily need capital from these large firms just because they say that they can offer you, multiple kind of stages of capital?
Yeah, I'd say that it just frankly is an empty promise that you're going to support a company for multiple rounds depending on what happens. And if the company's doing super well, of course they're going to want to invest, so no matter what. So I think the value add of hey, you have the capacity to double down over multiple rounds. Don't get me wrong, it definitely does. There are cases where it matters a lot. I know this because Ribbit invested in Robinhood 8 different times over the years, and it's been one of their biggest investments, and they've made money on all those times that they put in money. And you see examples like this in Web2, but Robinhood is a business that you wanted to invest in at every single point in time, right? It's if the company's good enough, that capital will come in any case. And so I don't think it's something that founders should be choosing based off of.
Makes sense. I wanted to ask you, in terms of the fundraising, when you started to fundraise, what would you say surprised you the most about raising your first fund?
Surprised me the most? I'd say that I'm still convinced to this day. Mahesh doesn't believe me, but I ran the amount that LPs who were investing in a 10-year fund, how correlated their yeses and nos were to whatever the liquid market did that week was insane. Virtually all of our checks came in, all of our commitments came in weeks where crypto had ripped plus 10%. And that was it. And crypto was down, I'm sorry, but we were just waiting until that week came. And I was there's no way people are committing 10 years of capital, and yet the weekly price really matters. And I ran the correlations every which way, and I'm still convinced to this day that actually maybe the case is we would have done those commitments eventually or whatever, but I think that was a very surprising fact to me, that just the market psychology is super intense even at every level.
Yeah, I think I had a similar experience where when I first started raising my first fund, I always assumed people that deploy into venture capital funds are way more sophisticated than retail investors in terms of understanding the long-term nature of venture capital. But it really seemed they also felt the similar kind of level of FOMO that retail would feel based on just the current market sentiment.
Yeah, pretty insane. And also on top of retail, they also have all sorts of principal agent problems depending on the type of LP. That's the game on the field that you got to play.
Yeah. And so how did you craft that initial story for LPs and how did that evolve over that fundraising journey?
To tell you, like there was a story we thought we were crafting, which was about how high conviction we were on DePin, how big the space was going to be, how novel these businesses were, and how big they could become. In reality, I think like very, very few of our investors actually cared about that or really understood what we were saying at the time. There was two reasons to invest in EV3 Fund 1. I'll say that. Number one is you were a venture investor who needed deal flow. And they were getting a lot of deal flow from different areas, but it's very hard to invest a $400 million fund into two or three categories. It's even harder when you have seven other $400 million funds that are competing against you for those same categories. And so we went to the founders of a lot of the venture firms we had worked with and said, like, hey, you guys should $1 million of your personal money. We're going to go and effectively seed this sector called DePin, and we're going to come back to you in 18 to 24 months with 15 different companies that are all going to be growing in really big markets, and they're going to make great Series A and B targets for you. The second reason was frankly just opportunity costs, like of Mahesh and I's time. It was just like, hey, you guys are working at Apollo and Ribbit. Those seem like pretty good jobs, good investment firms. You could stay there. You guys are young. Like, why are you doing this? And the fact that we could tell them with full conviction, like, yeah, we love those jobs and those people are great and they're investing in our new fund, but this opportunity is so big that we're going all in on it. We're putting all our money into it. We're staking our careers into it. And we're going to go and do this for the next 40 or more years of our life, if God willing. People invested in us because we believed in what we were saying had extremely high return potential. And we were putting our money where our mouth is.
Makes a lot of sense. Do you feel boxed in as like a specialist only looking at these certain areas? Or do you feel like it hasn't really mattered and you were actually able to explore other areas regardless of that initial thesis of just focusing on, DePin and real world use cases?
Yeah, I think one of the nice things about being a smaller fund is that you don't need to get everything right, but you need to get a few things really, really right. And I'd say we are extremely low velocity in our pace of insights. Like we've been doing this for 3 years and we've basically had two real non-consensus insights. One is in 2022, we realized that you can scale hardware networks with crypto. And we went all in on that, and more than half of our first fund behind that thesis and have backed a number of companies and helped scale that ecosystem. The second insight we had, which came in late 2023, was when we met Hirsch, the founder of Opacity, and he pitched us zkTLS. And we realized, okay, if you just learned that you can scale hardware networks with capital, with on-chain capital and labor and reputation, and now we're learning that you can scale software networks with reputation from other Web2 platforms. And to me, those are two equally sized, multi-trillion dollar ideas in terms of the economic value shifts that they'll enable. We found them at similar times when they were extremely non-consensus and nobody was talking about them within the investment community. And we were able to make really big bets early to help bootstrap both of those ecosystems. So I don't know, maybe we'll have a third insight in a year or two. Maybe we won't, but I certainly haven't felt boxed in by we've invested in wireless, energy, transportation networks, creator economy stuff, like a lot of different types of services that all fall under the umbrella of user-generated services that are coordinated by public blockchains.
Yeah, great point. Was there any rejection on that fundraising journey that really stuck with you?
Oh yeah, this one. There was another fund manager raising at the same time who I think had like 70,000 Twitter followers or something, and I had 5,000. I remember pitching this guy. We went around for a walk in Central Park in Manhattan, and then I took a bus in specifically to come meet this guy. And after like an hour walk, he was like, "Yeah, but like this guy has like 70,000 Twitter followers. Like he's just gonna see all the deal flow." And I was like, "Man, fuck that! Like that's one that I won't forget." But anyways,
did that push you to care more about Twitter, or you realize that that's just false signal?
Nah, there's capital that will chase Twitter followers. That's okay. I don't need to play in that part of the world.
Yeah, fair. And what advice did you receive from like other GPs that you were talking to or pitching that turned out to be completely wrong or surprisingly very true?
I think probably the best advice was from my old boss, Mickey at Ribbit. When we started EV3, he basically told us like, buckle in, you better like really believe in this because it's going to be a long ass time. He was like, look, I started in fintech when I was like 17 years old and now I'm 45 and people just started to give a shit like 5 years ago. So he was basically like, look, if you guys have conviction in DePin, that's great, but like don't expect this to play off in 2 years. Don't expect it to play out in 10 years. Like this thing is going to take a while. And I think that's the attitude you got to have when starting a venture firm, especially when doing something is focusing on a sector that's really non-consensus like fintech was in 2011 when they started, and like DePin was in 2022 and we started.
Understood. And I guess if you could maybe walk through the thinking of the more details on the fund, how did you think about the fund size, what size checks you're going to write, specifically what stage you're investing in, and that type of thing?
Yeah, we're investing out of our second fund now and investing between 500K and $2 million checks, generally leading or co-leading pre-seed and seed rounds. Our first fund was a little different. Our first fund was a little bit less than half the size of our second fund. It was a $20 million fund. And so at that scale, you have the flexibility to be really opportunistic in a lot of different areas, which I think was good and bad. As a GP, you really have very little oversight, right? If you're not careful, burn a lot of cycles on doing things that are not actually valuable for an extreme amount of time. And sometimes those bets play out and everyone's happy. And a lot of times it ends up being for nothing. And in fund one, we were really lucky to have the great partners who supported us to do some experimenting. And we did OTC investments, we bought locked tokens. We did a bunch of on-chain liquidity. We did some Series A investing. We did a lot of first check investing into DePin, which was our core. And what we figured out was that although there are a lot of ways to make money in crypto, and sometimes as a function of just being deep in the ecosystem, you see the opportunity to pick up, a nickel or dime here or there along the road. It's focus is the most important thing. And what we really lived for was working with founders to get them from zero to that escape velocity stage. And so that's all we're doing now in our second fund is focusing exclusively on, leading a small number of rounds, working extremely closely with founders. And it's something that our LPs are excited to support.
How do you do decision making in your firm? You and Mahesh are the two, founding GPs. How does that work? Are you unanimously have to agree, or you both get to kind of make your own calls?
It's a balance. I'd say probably half of our deals we agree on. Half of them, it's if one of us pounds the table and says hey, this is my pound the table bet for the next 3 months, then we respect that. And honestly, those have probably been our better bets, the ones where we have disagreed on. So yeah, this is the nice thing about having a small invest. I've known Mahesh now for 7-8 years, and I talked to him more than anybody else in my life, frankly. So it's the dynamic between investing is really well understood, and we sort of understand what kind of risks each other like to take, which is the most important, I think, thing. And we've learned over time that I have crazy risk tolerance on certain aspects and very small risk tolerance for certain other types of risks, and he has the opposite in some ways. And so when we think about opportunities and when we're debating them, it's the fact that I sort of know his biases, and he can put a mirror in front of me to tell me my biases when I'm looking at an investment is the most valuable piece of our process.
Yeah, I guess that's super helpful to have someone to bounce ideas off with as well. What would you consider your edge, and how do you maintain it?
So the edge is always founder reputation. Our edge is how founders talk about us when we're not in the room. I think that's true. Venture as a service business is how we look at it. And that's what we try to build. And because we're a small team, we have to build that in very few select places. And so our process is hey, we identify these insights like DePin or zkTLS. If they're non-consensus and we believe in them, we bet really big to build out those ecosystems. And then we do everything we can to support those founders in that early ecosystem so that when the ecosystems are growing, they've developed and they're attracting a lot of capital, we see everything first and we have close personal relationships with the people that matter. And so it's twofold. We're never going to have an edge investing in DeFi or in layer ones, and that's okay for us. But we have to be the best investors that are pursuing these novel ecosystems that we see, and we have to really bet big and bet right within those ecosystems when we find them.
Do you have an opinion on token investing compared to equity investing?
Well, as a pre-seed investor, you often get both, and so you're a little bit more insulated than later stage investors from an actual exposure perspective. I think equity markets are just generally entirely cooked. Mahesh and I were both Goldman bankers. We have seen how those markets get created, and there's a lot of inefficiencies to them. And you see that play out in the number of IPOs happening. You see the Web2 venture, it's something you put money in, but no one gets money out. Really, Web3 ventures place where you put money in and get money out if you're good. And so I think just structurally, all the vast majority of the Web2 venture ecosystem will eventually look once they need to deliver capital, realize that okay, the path to exits was actually through this crypto thing that I haven't paid attention to for the past 10 years, 5 for whatever years. And so we'll see a lot of that happening, especially as there's regulatory clarity. So we think networks can be bigger than equities if you're truly solving a coordination problem. We think that token market structure, for all of its shortcomings today and all the power that market makers and centralized exchanges have, still have the potential as more things move on chain to be fundamentally more efficient than what exists in Web 2. and to operate at a smaller scale. And that means that a lot of the actual liquidity back to LPs into the venture ecosystem is going to come from
Yeah,
tokens. I
great
mean,
point. You mentioned you're still in the early days of the firm, 3 years in, but you've also said you're investing out of your second fund. Curious how do you think about, the fund one and fund two, the journey between the two in terms of capital raising? What is it that LPs look for like a fund two when they're making a decision, since it's so early to even see returns out of a fund one?
I think a lot of it is consistency. If you went and did what there's this double-edged sword when you're raising your first fund, which is like, one, you know what the fuck you're doing, and you could do anything theoretically, and like that even if you come from an investment firm that trained you before, there are certain things you're going to have to relearn. And so it's a fine balance between like fund one being able to experiment and find your groove and make some mistakes in a way that doesn't blow you up along the way. At the same time, like if you tell LPs that you're going to make money in one way and you make money in another way, like depending on how much money you make them, of course, but like it probably like you're going to get more questions about what you're doing for fund two. And so this fund one was people were betting on our on the opportunity cost of me and Mahesh, and we were pitching a story. Now for fund two, people are evaluating like, okay, did you do what you were going to say in fund one? And like, do you have a coherent strategy that you're executing on? But it really is about consistency. If again, like fund one to fund two, like you got to figure out what your product is. Like what product are you offering to LPs? And for fund one, you don't need to because people are backing you as a founder. By the time you get to fund two, if you have returned capital and you're several years into like your fund life, I think that's different. If you're like raising funds back to back, where really it's just like the paper marks look good, but you haven't returned DPI yet. What folks are looking for is like consistency, coherency of the strategy, and frankly, like a lot are on co-founder alignment, and that's something that LPs care a ton about because it ends up being the thing that actually breaks up those partnerships in the long term. It's just like GPs, arguing over economics or about control or the future strategic rationale or transactions. And so really trying to understand the relationship between the GPs.
And you mentioned one thing that I'm curious about in terms of, coming out of another fund that you were previously working in, you probably have to unlearn some things. What do you think you had to really unlearn to become an investor at Escape Velocity?
The biggest thing is just the level of uncertainty of what you deal with at pre-seed. The underwriting is fundamentally different. And I would say in our first fund, whenever we were close on a decision and our conviction on the founder was different than our conviction on the thesis, and we chose to go with whatever like the thesis said, and we felt really smart about it, ended up being completely wrong in both directions. Like when we were super excited about a thesis, but so on a founder, and we decided to make a bet, terrible decision. When we were like really gung ho on a founder, but we were like, oh, this, it's a small market, I don't know about like the customers, XYZ thing. Also a terrible decision, like both the type 1 and type 2. At pre-seed, I think the decisions are just entirely founder-based. Like we've made investments where we wire the money and then a week later, like the company pivots. And so like it just like really both empirically in terms of the quality of decisions we made in fund one, and also generally like now that I've studied more early stage investors and how they operate, I think that making a decision based pattern matching to like the ideas and thesis and the market is really just a way for you to test conviction on yourself as to whether you can find the 10 reasons to say no, but you're like, fuck it, I have to back this founder anyways.
Yeah, great point. And what does success look for you in terms of the next 5 to 10 years for you and Escape Velocity? What are you working towards?
I just want to back the best founders that are building the biggest product networks that are disrupting real world use cases and building user generated services. I think crypto moves so fast that it's a fool's errand to go and project out 5 years forward what the best businesses or best companies are going to look like. We started originally it was like an investment DAO type of thing, and we were going to be anonymous founders. This was in like Q4 2021. And then it was like a ecosystem fund for DePin projects where we were originally, or for like DePin ecosystems like Helium. And then we were pitching a DY fund for a while, and then people were like, what the fuck is DY? Or like, it's too small. Then we were pitching a DePin fund, and people were like, well, there's nothing in DePin. Like, how can you invest in an area when there's like 20 companies in the space? And then we were just basically pitching our opportunity cost of like, hey, we really believe in the space. I guess what I'm trying to say is like, even though from the outside things look like really neat, in reality, it's just showing up and building every day, but keeping your North Star is really true. And for us, that's supporting and backing founders.
Really cool. I guess I was curious in terms of what would you say is like the most unexpected, difficult thing about starting a venture fund?
It's a good question. The sheer amount of uncertainty, I think, can is hard for many certain types of people to deal with. Both from a like GP and business perspective, like I mentioned, like venture funds become as a business sustainable like once you stack several funds or you have some returns, and they like one fund is not a business. And so I'd say for the first like 2 years, you're still like in default dead mode realistically, right? Or really until you return capital, you're in default dead mode, and it's on you to go improve it. So the toughest thing has been the moments of deep uncertainty. I'd say like we raised our first fund in 2022, and yeah, we had a bunch of money going into the FTX or going into the Luna crash. Luna crashed when we lost like more than half of it, and we were at like I don't know, we had like $3 or $4 million in commitments after that, and then we raised for 6 more months, and we thought we had 20 million, and then FTX crashed, and we were back down to like 12, and then you work your way up again. So like the raising the first fund is just a fucking dog of a process, and I don't think there's any way around it. The tough for me, I think the other tough thing, which I didn't expect, is just like, you know, you become friends, get really close to I'd say like conflicts and relationships with you and your founders is something that now I realize being in a GP seat is a very, very personal one. And the type of commitments that you make to founders is like, hey, if you call me when I'm out with my girlfriend at 9 p.m. on a Friday, like I'm going to choose you over her. And you end up getting really close to these people because of that. That means that when it goes south, it can feel really personal too. And yeah, it's something I think you don't get as employee of an investment firm, but you definitely feel it as the owner of one.
Yeah, that's a great point. What would be the biggest piece of advice you'd give to someone starting or wanting to start a venture fund, or maybe even starting to raise their second fund?
For someone starting, I'd say choose the right co-founder. By far the number one thing. For someone raising a second fund, we're just here now, so I'm not qualified to give advice there yet. Maybe next time on the pod in a few years we can give some tips there.
Cool. No, fair enough. And finally, what would you say is one secret obsession of yours that nobody knows about?
Secret obsession that nobody knows about. A few people know this, but one of the reasons, actually before Bitcoin, one of the things I got me into crypto and distributed computing originally was SETI. There was one of the first distributed computing applications that came out was called SETI at Home. It's basically, I'm here in San Juan in Puerto Rico. There's a telescope called in like 30 minutes away from here. It's a like 1.5 acre long telescope called Arecibo. They had this project where they were trying to like scan very, very low power, low frequency radio waves to try to search for signs of extraterrestrial intelligence. And this thing is like in the middle of the jungle in Puerto Rico. Like you can't like have it's like a data center there, right? So you can't process these huge amounts of data. And so what they came up with was a screensaver where anyone could download it. They would basically like batch up these huge packets of radio wave data, send it to you, and like while your computer was running its screensaver back in like the early and mid 2000s, it would run these kind of hashes in the background and basically scan for certain frequency or like I think they scanned for like prime numbers to prove that there was some sign of an intelligent life out there. And that was my original that then got me like into going deeper into like the deep web and torrenting, and then the Silk Road and like Bitcoin and all that other stuff. And I actually have, maybe you can see this, like I have this like from one of our portfolio companies. This is a telescope that I keep here, which the sky's quite clear here in San Juan. So astronomy is the secret obsession that I don't think a lot of my crypto friends know about.
That's pretty cool. It looks like a really cool telescope as well.
Yeah, it's called Unistellar. We recently invested in a DePin project that will allow owners of these telescopes and others to basically pool their telescopes to provide satellite tracking and other services. So you can earn some points for running your telescope. I'm sure in New Zealand the night sky is probably pretty nice.
Yeah, no, it's definitely pretty good. That's pretty cool. I should check it out. But that's great, Sal. I appreciate you taking the time to come on. I'm sure we'll probably have you back on maybe in a few more years to see how your thesis on escape velocity has played out.
Yeah, thank you, man, for having me on. This has been a blast.